There is a moment every serious student of markets eventually encounters, a moment when the comfortable fiction that prices move purely on logic, on earnings reports and supply data, and the rational aggregation of informed opinion begins to crack under the weight of observable reality. The crack usually happens on a Monday morning. It usually happens early, and if you have been involved in the silver market at any point in the past several years, there is a meaningful probability that you have experienced it personally, felt it in your account balance before you had finished your first cup of coffee, and blamed yourself for it entirely. That is the purpose of today's discussion, to examine whether your self-blame was warranted and to introduce a framework for thinking about the silver market's most dangerous daily window with rather more precision than most commentary offers. Silver opened this Monday, April 13th, trading sharply lower, between $73.58 and $75.02 per ounce, down between 1.6% and 3.5% in early trade, as the collapse of U.S.-Iran peace talks in Islamabad triggered what analysts described as an absolute unwinding of optimism, with capital flowing rapidly into the U.S. dollar index. Whether you were positioned long, whether you had a stop loss sitting just below last Friday's close of approximately $75.93, and whether that stop loss was triggered in the opening hour of today's session before silver found any semblance of footing, these are not merely hypothetical questions. They are the lived experience of a substantial number of silver market participants on this particular Monday morning in April 2026, and the pattern they represent is not new. It is, in fact, quite old. It is simply not discussed with sufficient directness. Let us establish the architecture of the problem before we examine its mechanics. The silver market, unlike the equity markets most investors grew up understanding, does not close at 4 o'clock in the afternoon and sleep until 9:30 the following morning. It runs, in one form or another, across the globe continuously. The Asian session opens in the evening Eastern Time. The London session begins its serious business in the early morning hours, and the New York session, the COMEX-anchored heart of silver futures trading, does not officially commence until later in the morning. The best trading window in terms of peak liquidity is generally considered the 8 a.m. to 12 p.m. Eastern Time overlap between London and New York. That observation, unremarkable in isolation, becomes enormously significant when you understand what it implies about the hours that precede it. The period between approximately 5:30 and 7:30 in the morning, Eastern Time, is a different market entirely. The Asian session is winding toward its close. London's volume is not yet fully transferred to New York. The algorithms that will anchor the COMEX's price discovery later in the morning are not yet operating at full capacity. What you have in that quiet window is a market in which a comparatively modest quantity of money can move price by a comparatively immodest amount. This is what professional traders mean when they use the term liquidity window, and it is important to understand it precisely, because the word liquidity is one of those terms that, like volatility, gets used so frequently that its actual meaning evaporates through overuse. A liquidity grab is a price action event where the market moves to a specific area where a large concentration of orders, typically retail stop losses, are clustered, triggers those orders, and then sharply reverses in the opposite direction. The term describes the way institutional and smart money players grab the liquidity available at those price levels to fill their own large orders. This is, stripped of jargon, a description of something that any student of human nature could have predicted without knowing a single thing about futures contracts. Large participants need to buy large quantities. Large quantities cannot be bought efficiently unless there are large quantities being sold simultaneously. The most reliable way to generate large quantities of selling in a thin market is to push the price down to where automatic sell orders, stop losses, have been placed. The selling is not motivated by the seller's genuine conviction that silver is worth less. It is motivated by the mechanical architecture of their risk management. They are not bearish. They are simply, suddenly, underwater. Now here's the detail that most commentary on this subject omits. There is a subtle but important distinction between a stop hunt and a liquidity grab. A stop hunt specifically refers to driving price to where stop loss orders are concentrated. A liquidity grab is the broader concept encompassing the underlying purpose, collecting the liquidity generated by triggered orders to fill institutional positions. Institutions are not hunting stops for the entertainment of watching retail traders suffer. They are hunting stops because triggered stop losses represent the only source of sufficient selling volume to allow a large buyer to acquire a position without simply bidding the price of silver upward against themselves. The predation is, in this sense, logically necessary from the institution's perspective. That does not make it pleasant to be the prey. But understanding the predator's logic is the first step towards ceasing to be reliably victimized by it. And this is where I need to pause and ask you directly. Because what I'm about to share in the next 2 sections of this discussion is the part that most financial content either stops before reaching or deliberately obscures. If this framework is already shifting how you think about your Monday morning experience in the silver market, then this channel deserves your subscription right now. What I am describing here is not common knowledge packaged in unusual terminology. It is a genuinely different way of reading market structure, grounded in the actual behavior of large institutions rather than the simplified narratives that retail-facing financial media tends to construct. Subscribe, turn on the notification, and stay with me, because the mechanics of Monday's open, especially in a market as charged with accumulated news and weekend sentiment as silver is right now, are about to become considerably clearer. Silver entered 2026 with strong momentum after a 120% price surge in 2025. J.P. Morgan Global Research sees silver prices averaging $81 per ounce in 2026, a figure that, against today's trading range, suggests the market believes there is substantial distance yet to travel in this cycle. But between the current level and any future destination, the path will be traversed in daily increments, and those daily increments will include Monday mornings. Many of them. Each with its own liquidity window, each with its own potential for the move you were right about to be executed incorrectly because of a stop loss that sat precisely where an institution needed to generate selling volume. That is the problem we are here to solve. Let us now descend from the architectural to the mechanistic, because it is one thing to understand conceptually that institutions use low liquidity windows to reposition, and quite another to understand the specific sequence of events through which that repositioning actually occurs on a Monday morning in the silver market. The sequence matters. It matters because once you can see the stages, you can identify where you are in them, rather than discovering after the fact that you were in stage 2 when you thought you were watching stage 4. The first stage is accumulation of informational advantage over the weekend. This is the part that most retail participants find most uncomfortable to acknowledge because it requires confronting an asymmetry that no amount of individual effort can fully bridge. Worries that there could be a tariff on U.S. silver imports, aligned with broader Trump policy or Section 232 investigations around critical minerals, saw a lot of metal moving from London to New York, movements that institutions tracked in real time with analytical resources that are structurally inaccessible to individual participants. When markets close on Friday afternoon, the news does not stop. Geopolitical developments continue to evolve. Central bank positioning data gets processed. Options market exposures get recalculated against new price levels. The institution's weekend is not, in any meaningful sense, a weekend. It is 65 additional hours of preparation for a Monday open that the retail participant approaches with the same information they had when they placed their trade on Friday. By January 2026, silver lease rates had exploded to around 8%. When someone is willing to pay 8% annualized just to borrow silver so they can be sure to take delivery on time, that in itself is a signal. Physical supply and demand are severely out of balance. Large institutions monitoring lease rate data, COMEX registered inventory levels, and the growing premium that Asian buyers were paying for physical metal, with Shanghai trading at significant premiums over COMEX, with arbitrage not closing because there is not enough metal to move. These institutions arrived at Monday's open with a substantially richer picture of where silver's pressure points were than any individual trader refreshing a price chart could construct. The second stage is the positioning of the bait. This is perhaps the most counterintuitive element of the Monday morning pattern because it looks on a chart exactly like what it is not. When silver drops sharply in the 6 a.m. window without an obvious news catalyst, the instinct of any technically oriented trader is to search for the fundamental cause. Financial media will supply one, post hoc, with reliable promptness, profit-taking or technical selling, or a reaction to some minor data point that was released overnight. Liquidity grabs can be identified by watching for rapid movements into and out of liquidity-rich areas, followed by quick price retractions, often marked by specific candlestick patterns like hammers or shooting stars, or candles with long wicks indicating sharp rejections. What you will not typically read in the financial press, because it is difficult to prove in any individual instance and therefore professionally hazardous to assert, is the more parsimonious explanation that the drop was manufactured to collect the stop-loss orders clustered below a well-known support level. Retail traders universally experience the exact same frustration. The stop-loss gets hit by a fraction of a point, and then the market immediately reverses and sprints straight to the original take-profit target. The universality of this experience is itself the most compelling evidence that something systematic is occurring. If stop losses were being triggered by genuine selling pressure driven by new information, the distribution of these events would be somewhat random, sometimes stopping out longs, sometimes stopping out shorts, sometimes occurring at price levels that were not particularly well known or technically significant. Instead, the pattern concentrates with remarkable consistency around round numbers, well-publicized support levels, and the specific time windows characterized by lowest liquidity. The probability that this concentration is coincidental diminishes with each recurrence. The third stage is what traders sometimes call the sweep and fill, the moment when the institution, having pushed price to where the stops were located, having collected the selling volume generated by those triggers, quietly reverses and becomes the buyer of everything that the panicked stop losses just offered for sale. This is the moment that, viewed in isolation on a 5-minute chart, looks like a V-shaped recovery. Commentators describe it as strong dip buying, or bargain hunters stepping in. And these descriptions are not technically incorrect. They simply omit the agency that manufactured the dip in the first place. Silver surged in 2025 after breaking decisively above long-term resistance at $50, marking a clear shift in market behavior, driven by tightening physical supply, accelerating industrial demand, and a renewed global liquidity cycle. The structural case for silver is not in dispute among serious analysts. What is in dispute, or rather what is insufficiently examined, is the relationship between that structural case and the week-to-week, session-by-session price behavior that retail participants must navigate to benefit from it. Being correct about silver's long-term direction is a necessary condition for profitable participation. It is not a sufficient one. You must also survive the short-term predation that the market's structure makes both possible and, from the institution's perspective, rational. What the silver market lacks is not paper claims on future silver, but metal that can be loaded onto a truck today. When the futures market falls into deep backwardation, the message is crystal clear. Silver you can take delivery of right now is far more valuable than silver promised months in the future. That physical reality creates the volatility that creates the Monday morning opportunity for large participants. The tighter the physical market, the more aggressively leveraged the paper market's participants tend to become. The more leveraged the paper market's participants, the more stop losses there are to hunt. This is not a bug. It is, from the perspective of the institution that can see where those stops are clustered, an entirely predictable and replicable feature of the market's architecture. We arrive now at the practical question that every honest discussion of this topic must eventually address, not the colorful architecture of institutional predation, which is intellectually interesting but ultimately not sufficient to pay anyone's bills, but rather what you do with this knowledge in the specific context of the silver market as it exists today, in April of 2026, with spot prices navigating a range between $73.58 and $76, and the entire geopolitical and macroeconomic backdrop shifting with a rapidity that would exhaust the descriptive vocabulary of a seasoned foreign correspondent. The first and most important practical implication flows directly from the analysis of the low liquidity window. Do not place new silver trades between approximately 5:30 and 7:30 in the morning Eastern Time. Consider carefully that the best trading window for peak liquidity in silver is the 8 a.m. to 12 p.m. Eastern Time overlap between London and New York. The corollary of this observation is that the hours preceding this window are characterized by precisely the conditions under which manufactured price moves are easiest to execute and hardest to distinguish from genuine directional signals. An entry that looks compelling at 6:15 a.m., a support level holding, a minor technical pattern completing, a price that looks like it has found its footing, is not operating under the same conditions that will govern silver's behavior when the full institutional participation of the New York session arrives. The setup that looks valid in thin, early morning trading may be rendered entirely irrelevant by what happens when real volume returns. The second practical implication concerns stop-loss placement, and here the analysis suggests something that may seem, on first consideration, counterintuitive. The conventional wisdom of tight stops, minimizing loss per trade as a way of managing overall risk, operates on an assumption that the market's price movements below your entry are driven by genuine selling pressure reflecting new information. When the mechanism for a stop hunt is operating, this assumption is violated. Liquidity grabs occur in areas where traders expect significant resistance or support, points on price charts that historically have reversed or stalled price movements. During a stop hunt, the sudden price movement happens when large traders push the price to these sensitive levels to trigger clustered stop-loss orders, allowing large traders to enter or exit positions at attractive prices. The practical implication is that stop-loss is placed at technically obvious levels, just below a round number, just beneath last week's low, just under a well-published support zone, are, in the context of the early morning window, not risk management tools so much as invitations. The institution does not need to know your specific stop loss. It needs only to know where the largest concentrations of retail stops are likely to be, which is a question that any technically sophisticated market participant can answer approximately correctly simply by looking at the same charts that retail traders are looking at. The third implication involves what serious traders call the gold-silver ratio, a metric that, under normal circumstances, functions as a relative value indicator, but which, in the context of Monday morning price action, becomes something considerably more diagnostic. When silver underperforms gold in the opening hours of trading, when the ratio rises, meaning it takes more ounces of silver to purchase an ounce of gold, this tends to indicate that the selling pressure in silver is driven by fear rather than by fundamental reassessment. Fear-driven selling in thin, early morning markets is, by its nature, more likely to reverse when institutional participation increases later in the morning. When silver outperforms gold in the opening hours, when the ratio falls, it suggests that genuine buyers are present, that the physical demand reality which has driven silver's rally, fueled by industrial demand and tight supply for multiple consecutive years, is manifesting in the paper market rather than being temporarily overwhelmed by it. Unlike gold, silver has no central bank backstop. There is no lender of last resort when inventories run thin. That makes price moves sharper, faster, and far more explosive. This structural characteristic of the silver market, its relative smallness, its dual identity as both industrial commodity and monetary metal, its vulnerability to the kind of early morning repositioning we have been discussing, is simultaneously the source of its most frustrating short-term behavior and the source of its most compelling long-term opportunity. The very thinness that allows it to be pushed around in the early hours is the same thinness that, when genuine institutional demand arrives in force, generates the kind of vertical price action that has defined silver's major moves throughout its history. Silver's current nominal all-time high is $121.67, set on January 29, 2026. Between today's range near $73 to $75 and that January peak, there is a story of extraordinary volatility, of margin hikes and geopolitical shocks and early morning stop hunts and recoveries that left patient holders intact while shaking out leveraged participants who had their stop losses positioned at exactly the levels the market needed to sweep. The lesson of that story is not that silver is uninvestable or that institutional predation makes participation futile. The lesson is considerably more constructive. Patience, combined with an accurate understanding of the market's daily rhythms, is the one competitive advantage that does not require an algorithm, a Bloomberg terminal, or a team of weekend analysts. Now, before you go, I want to ask you something specific and genuinely mean it. What is your experience with the Monday morning silver window? Have you been stopped out of a trade that subsequently went exactly where you expected, only with you no longer in it? And more interestingly, what is your approach to managing around the early session volatility? The comment section of this channel functions, at its best, as a genuinely substantive conversation among people who are thinking carefully about these markets, and your experience, whether it confirms the pattern we have discussed today or complicates it, is relevant to the analysis. Drop it below. I read them, and the quality of the thinking here consistently exceeds what you will find in most professional commentary on these topics. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions, so you can make your own decisions with your own money and your own risk in mind.